Hello, mortgage fans. Okay, so this is the week we've been waiting for. Pubs and hairdressers and salons and all sorts of things are open, so you can get waxed, clipped, trimmed, dyed to your heart's content. Also, beer gardens being open is very exciting, and in true British form, it is hammering with snow out of my window right now. So, if anyone wants to sort of ski down with their salopettes, I'm sure many people will be sort of brave enough to do that. But anyway, the main focus of this weekly update is what I've labelled the payback. So, cast our minds back to a year ago now. We're sort of into the first lockdown. It's 25 degrees. That was probably the only upside. But what happened in the background, there were lots of things like bounce back loans and CBILS loans that were being organised, and they are now starting to be paid back. So we're going to enter a bit of a weird sort of time in how banks assess affordability. If you own a business that's taken one of those loans, nothing wrong with that per se. You're not going to get declined. But what banks will have to do sort of through this period is sort of make some assumptions. Is they'll look at your profit and they'll probably take off what the forward going costs of the loan are before they're assessing what they lend you. It'll be a little bit speculative. Banks' policies will differ. We've got a few meetings with banks this week to sort of clarify how that's going to work, so I'll probably know a bit more next week. But the main thing I just want to sort of point out is that just be aware that that will come off the sort of profit from last year. Once we roll on a year, it won't be so bad because that will be factored into different companies' P&L. So just be aware of that. It's going to be a bit of a sort of funny time over the next few months until banks sort of have a standard policy around how these things are assessed. Equally, if you work for a business that's taken those loans and may well just be in a sector of high risk, as has really been the case, banks are going to look at that in a bit more detail. So we're just going to enter a bit of a sort of funny time. It really reminds me, funny enough, of back in 2008. If you tried to get an investment banker a mortgage in 2008, good luck, it was hard. You know, it's down to that sort of sector specific stuff. So that's sort of where we're at again. People need to get their head around it. But just sort of a word of caution really is that I don't think it's going to stop anyone getting lending that should get lending, but it just will be a bit more intrusive. It might be a little bit more difficult until a sort of standard way of working is figured out over the next sort of few months. Off the back of that, though, we've seen yet more positive house price data. Halifax released their figures. So for March, they believe house prices went up 1.1%, which makes house prices 6.5% higher than this time last year, which is taking the average property value in the UK to 254,606, and that's the highest average figure they have ever recorded. So obviously, on the flip side, you've got sort of, as I mentioned before, about the bounce back loans, all that sort of thing. You've got one side of the economy very choppy, on the other it's flying. So it's a very mixed picture. So sort of funny to that, what we tend to do is each quarter we look at the lenders we use. So I've done a Q1 2020 versus a Q1 2021 just to see what the differences are. We've seen a 16% increase in lenders used, which isn't a surprise because more lenders are going back to the market. And we're seeing two notable movers up in our top 10. So Coots are now in the top 10 and Clydesdale moved up to 5th position. So that's massively above their sort of national averages and probably more reflective of the larger and more complex work that we're doing as well. So it's good to see that sort of work coming back, and it's good to see the lenders supporting that. So that's actually been a really positive move on that side. With money markets, all pretty flat, all sort of levelling off at the minute, which is to be expected. So we do expect sort of mortgage pricing to be relatively flat, nothing sort of change over the sort of the coming weeks, months, unless anything significant changes. The one probably thing that will change is we still haven't seen the big six banks come into the 95% lending yet. There was a bit of a sort of Mexican standoff, so I suspect that can't last much longer. So this week next, I suspect we'll see some of the big players come in, and then they'll play the classic game of, I think the market leading rate at 95% at the moment, I think is 3.95%. So I expect someone to come in at 3.9, then it'll be 3.85. You get the game. So just sort of shuffle pricing down a bit over the coming weeks and months. So nothing quickly, but I think that the pricing will move down in that area over the coming weeks and months. Which means then the best rate you can get on a mortgage is 1.05% if you've got a big deposit, a nice straightforward situation. But as ever, the rate you'll be offered, will be dependent on your personal situation and your deposit. So that's it for this week. I'll put a link to the text update with a lot more facts and figures, and hope to see you soon.